In the last video, we asked a simple question: why doesn't your income match your bank account? And the answer was timing. Now we're going to build the tool that explains that timing, called the cash flow statement. But before we build it, we need to understand what it's actually doing. The cash flow statement answers one question: how did we get from net income to cash? We start with net income and then we adjust it. There are only three types of adjustments: non-cash items, changes in assets, and changes in liabilities. That's it. Let's make this intuitive. If an asset increases, you used cash, so you need to subtract that from net income. If the asset decreases, you didn't use cash and you add it back to net income. If a liability increases, you didn't pay cash, and so you have to add this back to net income. And if it decreases, that is, if the liability decreases, then you paid cash, which means you need to subtract it from net income. That's the entire logic, although admittedly, it takes some practice and some examples to understand what I mean by this. So now let's map it to your system. You will have some assets called prepaids, and there'll be a number of different prepaids, okay? So you'll have subscriptions, you may have gym memberships, anything where you've paid first and then you'll allocate the usage of that over time. You'll also have wages receivable. That is income that you've earned but not yet paid, okay? On the liabilities side, you're going to have payables. You can think of these as amounts that have totally accrued that you've then moved from accrual into a payable because the bill has told you that it needs to be paid by such and such date. Okay, so you have payables, you'll have some accruals at month end, and you'll have credit card balances at month end. These are the accounts that explain why cash doesn't match income. So now that we understand the logic, let's build it. We're going to use our financial system, the personal income statement tab, the net worth statement tab, and everything will tie back exactly. Now, whereas you'll see the cash flow from operations on this picture, you need to think of that as cash flow from living activities, because that's what it is. It's not so much operations as it is just your life. All right, so an example is going to help with understanding how to put together the cash flow statement. Up to this point, if you followed all of the other seasons, what you will have as an end result is a personal income statement for the period ending and then whatever month it is that you did this for. You should have something, and I'm using this as a base case because even though your scenario will be different because you'll have a different mix of assets, prepaids, accruals, payables, essentially this is as basic as you can get before adding on some of these bigger significant events that happen in life. But everything that we've covered up to this point is contained and gives you the foundational knowledge, the principles that you can apply to your own unique scenario. So this particular example, this scenario, is as close as I could get to be representative of someone in their early career life. Okay, so if you've gone through this and you have sort of the model life, okay, which nobody does, there's messiness, but we have to start with something, then this is what it would likely look like. Okay, so what we see here is the salary income for the month of April is $5,000. Now, what this tells you is, okay, if we were to annualize this, this would be approximately $60,000, which is reasonable for someone in this day of age to be earning sort of on average, okay, in that 60,000 range, if you've got a reasonably good job. Okay, so then we get into our expenses, and we have all of our different expenses here. Now, the important point for me to communicate for the cash flow statement purposes is that, remember, all of these expenses are either paid for in cash, okay? So it's already representative in our net income figure, or they're accruals, or they're prepaids. And some of that portion that's either a prepaid or an accrual, even though it shows up in the expense account, there has not been the movement of cash. Okay, so keep that in mind. We then move down and we get to things like employment insurance, depreciation expense. Depreciation expense is actually going to be where we start because it's a transaction that, although it represents an economic consumption of value, there was no cash that actually moved. So the first step that we're going to get to in a moment is adding that back to net income to get closer to what the change in the cash flows was, okay? And that's really the purpose of the cash flow statement. So we have our personal income statement, our net worth statement. We have a number of different assets and liabilities. In this particular case, at the end of the month, we have our checking account balance. Okay, and if we've done the bank reconciliation process properly, then the balance here should equal the balance in our checking account. Cash savings, so this comes as the result of transactions, saving from your checking account into your savings account. We have wages receivable. This is income that has been earned, but no cash has moved yet. Okay. Income tax receivable. This is basically cash that we have taken from our gross wages and put into our income tax account with the Canada Revenue Agency if you're in Canada. Okay, so because it gives you a future benefit, we're keeping that as like an account. It's a restricted account. You can only use it to pay down taxes, but it still provides economic value, which is why I've included it here. CPP receivable, this comes as the result of your own contributions, but also from the employer contributions. And that difference is important because one involves cash, your contributions that come off your paycheck, and one doesn't, which is the employer's contribution. So we have to keep track of that. Prepaid rent, we have a zero balance here because we make the prepayment, we pay for our rent at the first of the month, and then we use it throughout the entire month and it gets used up. So we realize it and we clear that account out at the end of the month, so there's a zero balance. Same thing with car insurance. This would be different for car insurance for you if your car insurance wasn't prepaid at the beginning of the month. You would have some sort of a prepayment in that account. Okay, we have a little bit of prepayment remaining from our Netflix. We have a little bit of our prepayment remaining from our Spotify. And we have our car and our accumulated depreciation. Okay, that makes up our assets. On our liability side, we have our accounts payable, which are expenses that have entirely accrued. And once they've gone through that entire usage cycle, we've moved them into the accounts payable because they need to be paid at some point. Credit card payable, same thing. So as we make payments, as we make purchases, our credit card payable balance will increase. As we pay the credit card off, that balance will decrease. So if that credit card payable balance increases or decreases, that's going to tell us something about cash that has been used. Income taxes payable, this is a result of accruing income taxes that matches when we work, okay? Which is why the income tax accrued is different from the income taxes receivable. Remember at month end, if you've worked a certain amount of time, but you have not yet been paid, then you're going to have the wages receivable, okay, the accrued wages. During that period of time, we're also matching our income taxes with an income tax expense and an income tax payable or accrual. The reason why our income tax receivable and our income tax payable do not match is because we only realize the income tax receivable when we receive the paycheck, whereas with the income tax payable, we realize that when we earn the income, okay? So that's important, and we'll deal with that when we get to this cash flow statement. Then we have all of our accruals, which again comes as a result of using the services until month end, but not having yet paid for it. Okay, that gives us our total liabilities. Our equity is a pre-system residual. This is because this is our starting point, and it's essentially a plug, which means that all of our assets plus all of our liabilities, or sorry, all of our assets minus all of our liabilities have to equal our equity. We're going to know that we have some CPP employer contributions. That's going to equal our own contributions, okay? Which is why our CPP receivable started at 15,000. Okay, this one started at 7,500 because that's how much CPP has been contributed. We've received $500 of gifts in the past. We've received, and if you don't remember, gifts that you've received in the past, it's not a big deal. That would just be 0 as a starting point, and it would roll up into whatever your equity is in a pre-system residual. And then in this case, we have our retained earnings. So we have our total assets equaling our total liabilities. Okay, so that's the setup. What we have to do is we have to create a number of schedules. The first one is receivables. And all I'm taking is all of the different accounts in our net worth statement, okay, that are not prepaids. So cash, savings, wages, income tax receivable, and CPP receivable. We need the beginning amounts and we need the ending amounts. For cash, it's a specific case. This is what we're trying to explain. We're trying to explain with the cash flow statement why the beginning and the ending are not, or rather not that they're not equal, but where that difference comes from, okay? Savings, we can see that our beginning amount, and this one's the wrong way away. Actually, the ending amount on this for our savings account, yeah, it should be 4,000. The beginning amount is actually from our journal entry, and it's the 3,500 here. Okay, so the difference there is $500. Okay, and I just want to make sure that all of these are accurate. Yeah, they're all accurate. Okay, so that means that we have a change in our savings account that is going to be classified as an investment. We have a change in our wages receivable account that is going to be classified as cash flow from daily living. We have a change in our income tax receivable that's also going to be classified as a cash flow from daily living. And we have a CPP receivable, and this here is going to be classified as an investment. It's an investment in the CPP plan, okay? Now, be careful with this because this amount here, okay, this 509, that is horrible. Let me just change that back to black. And what I wanted to do was I wanted to highlight it, and it looks like I've almost, because I chose white. So black, okay, whatever, that works. We got to be careful because this 509 represents both our contribution, which did involve cash, but also the employer's contribution, which did not include cash, okay? If you don't get that right, then your cash flows are not going to balance at the end. All right, so what we do is we want to calculate the change in our accrued assets, and just the ones for our daily living, so just the wages and the income tax. Now, if we think about this, what we're trying to do is we're trying to get from net income to change in cash. So I mentioned before that we had to add back depreciation. That's the first step, okay? So we take our income statement, our $405.71, and we add back this 83.33. Okay, so this is sort of the setup. We're first going to deal with the cash flow from daily activities. And this section is really important to understand because it's very easy to get tripped up. All right, so we've added back the 83.33. Then we need to subtract this change in our accrued assets. If we go back here, let's explain why that is. And we're only talking about these two here, okay? Our wages receivable, our accrued wages, was $1,615.38 at the beginning of the period. At the end of the period, it's $2,076.92. That increase of $461.54 is the change in accrued wages. Okay, so this is money that we've earned, but we have not received in cash. Okay, so net income includes it because it is a measure of economic value created. But because we want to deal with cash, we have to subtract that out. Okay, so that's the first adjustment. Income tax receivable is a similar thing. Okay, we've paid money into our income tax receivable account with the CRA if you're in Canada. And that amount that we've paid into it has changed from the beginning balance to the ending balance. So we've paid $830.76 into that. Our net income, okay, it has that increase in that asset involved in it, and we have to back that out. So we have to subtract this change in accrued assets. Okay, so that total is the $1,292.30. Now we move on to our change in payables. Okay, so our change in payables, this one's going to be, and you would have a change in prepaids here, so maybe I'll just add that just for completeness. If we want it to be complete, just so that you know I didn't skip over it, we would subtract an increase in prepaids. Okay, if you had a decrease in prepaids, then you would add the decrease in prepaids. Okay, but in this example, this is going to be 0. And that's because when we go through and look at the beginning balances and ending balances of these two, the difference is 0, so the total is 0. All right, next we move to our payables. So we set up a schedule. We have all of our payables listed here. We can grab those from our liabilities on our balance sheet. Okay, so it's just these 4 here. And again, we want to calculate the difference. How have these changed as a result of transactions? The beginning balance for payables was 280, the ending was 280, no change. For the credit card payable, it changed from 900 to 1,092. Okay, so what does that mean? It means that the liability increased, and that is a source of cash. We've bought things, but the liability has increased, and so it's a source of cash. So what that means is we need to add the change in the payables because the payables on net increased. Okay. We skip over the car loan payable. That's related to what we'll categorize as a financing activity. And we have to include this income tax payable, this accrued amount. Again, the income tax payable accrual, this means that we've accrued these income taxes, but it hasn't involved a cash flow, right? And so that's part of the reason why this 1438, which is the income tax payable and the credit card payable, have to be added together and added back because there's no cash that has been used. Okay. All right. From there, we then address our accrued liabilities. Okay. All of our accruals, we take the beginning balances, we subtract the beginning balances from the ending balances, and we get a negative number. This means that we've made extra payments because the balances have dropped in all of our accruals. it means that we've made extra payments, we've used cash, and we've used it for $9.62. Okay, so if we total all the accruals in the beginning of the period, all of the accruals in the end of the period, then there would be a change, and that change represents paying down these accruals. So we've used up that cash, which means we need to subtract it. And then we just sum all of these values. And that tells us that the total cash flow from our daily activities was $625.26. Okay, so that is the first section of the cash flow statement. The next section is cash flow from investing activities. Okay, and the two cash flows from investing activities that we have is 500. This is negative because it's a use of cash. Okay, so 500. And the change in the CPP receivable, only your own portion. So we had to take 50% of the difference of this value, this 509.52. Okay. So those two represent the investing activities. So the total investing activities that we conducted during this month was $754.76. Okay, that's great. We've got surplus cash from our daily living, and we are investing in our future. The last section that we have is our cash flow from financing activities. This will include both debt and equity injections, okay? Most of the time, it'll be just dealing with debt repayment, or if you get new debt out, then the value of the cash that you've received for that debt. In our case, we only have the car loan payable, but if you were to, let's say, get a gift from someone, okay, a financial cash gift, or if you were to receive an inheritance, that inheritance would be an injection of cash into your bank account. And then, so we know that that's a debit. For the credit, where do we put the credit? It's going to be in our equity section, okay? And in that equity section, because it impacts the equity section, this is a financing activity. So essentially an inheritance is somebody investing in your equity or building your net worth, okay? So that would be another example of an item that would show up here. But in our example, we just have the principal portion of the car loan payable, and we've paid that. It's a use of cash, so it's a negative number, 121. Okay, and that's the only one that we have in this particular example. So that's our total cash flow from financing activities. Our beginning cash, this $2,800, this comes from our opening entry. Okay, so or last month's balance sheet, whatever the cash amount was. So this value is 2,800. Okay, let me go back. So 2,800 is where we start. This change in cash flow is the sum of the cash flow from our daily living, okay, or our cash flow from daily activities, minus we add the negative number, okay, so I'm just saying minus 754, this is from our investing activities, and then minus our cash flow from financing activities of the negative 121.17. So we've used up $250.67 in total of cash, which means that the 2,800 now at the end of month, again, assuming we've reconciled and all the transactions are correct in our journal, the ending balance should be $2,549.33. And if this has been done correctly, you can go to your net worth statement and you can see that the cash balance is in fact $2,549.33. Okay. So that is the general procedure of how you go through and you create your cash flow statement. And it's used really to show you, where did the cash go? Did it go to daily activities? Did it go to investing activities? or did it go to financing activities? Now, throughout these different seasons, this is the base case scenario. And you can think about, now that we've gone through this, what would happen if you had sort of a mortgage, right? If you had a mortgage, you would have an asset on your net worth statement. You'd likely have a liability representing the mortgage. Okay, that's a financing liability. That mortgage would show up in the cash flow from financing activities, and just the principal portion that you were paying down on that mortgage would show up there. Where would the interest on the mortgage go? Well, similar to the interest that we looked at here in the accruals, the accrued interest in the car loan and the accrued interest for the credit card, these would go into the uh, cash flow from daily activities. Okay, so cash flow statement, very, very important. And that rounds out the creation of our three different statements. So now you can explain your cash, not just what you earned, but what actually moved. In the next video, we break this into our daily activities, investing, and financing, so you can see exactly what is driving your financial life.